Really what you have to focus on is the fiscal picture in the US. So baseline, President-elect Trump's proposal is, to cut corporate taxes from 21 to 15%, extend the individual tax cuts, which are set to expire at the end of 2025. Baseline, that adds 500 billion to the US deficit. It's highly stimulative and highly inflationary. So I suspect that the price action we're seeing will continue. This is not a short-term price reaction. It's going to be more of a secular trade that unfolds over the next several months. The U.S. is running a 6% deficit currently, and the Republican proposals are going to increase on the order of 2 to 3%. So we'll be running 9 to 10% deficits in the U.S. Again, very stimulative. And if we look at Europe, for example, the underperformance part of the story there is a lack of fiscal expansion. The problems in Germany, if you look at the finance minister, it's a fiscal conservative. So the debate is over spending, right? And the US expansion and part of its outperformance has been related to this large fiscal expansion.
Let's stay with the U.S. for a moment, because you're highlighting there that we could see a deficit of 9 to 10% for the United States. At what point do you think that treasuries will actually become a problem for U.S. equities? At what point can the performance in the bond market actually cap the gains for U.S. equities, given that we could be running large amounts in deficit for the U.S.?
Yeah, that's an excellent question. So if we go all the way back to the 90s, Bill Clinton in his second term actually ran on a platform of austerity. He won, implemented tax hikes, spending cuts, and that's when the deficit was 5%. So outside of wartime, we haven't run this level of fiscal deficit in the U.S. And if we look at 23, just before the Federal Reserve's pivot, the 10-year backed up to about 500 basis points, and that started to weigh on equities. So post-election, we hit maybe 447 on 10s. So I suspect that pressure towards 5 with this fiscal backdrop is going to start to shift the frame a little bit in terms of the performance of risk premium, including equities. So yeah, the 5 level I think could just based on historics could pressure stocks.
We'll keep an eye on that, but I would like to get a comparison as well in terms of the performance for U.S. equities and European equities. I believe we have a chart that shows us the performance for the Stoxx 600 versus the S&P. Looking at it year to date, the Stoxx 600 is up almost 7%. I'll give it the 7%. The S&P is up 25.7%. Christian, what I would like to understand here is, where do we go from here? Is there any sort of upside for European stocks when you compare to what we have seen on Wall Street thus far this year?
Yeah, I mean, probably more in line with historical norms as far as the equity risk premium goes. But Europe just structurally has a lot of problems at the moment. And as I said, fiscal is part of the issue. So you have countries like France and Italy that are bumping up into their fiscal constraints. We had Mario Draghi's report on how to improve Europe, and fiscal is a big cornerstone of that. And as I mentioned with Germany, the issue is around fiscal and spending. So I suspect without a big fiscal impulse in Europe, it's just going to be very difficult to see a similar performance to the United States. So the outperformance will continue in the US relative to Europe.